other investment options. Going beyond debt funds give you the opportunity to look at fixed income investments that qualify for income tax deductions. Hello and welcome. I am Prarthana from ClearTax, India's largest tax and financial services platform. At Clear, we have assisted 6 million plus tax filers so far. If you have not already, do subscribe to our channel to support us. Debt funds are mutual fund schemes that invest in fixed income instruments like commercial papers, certificates of deposit, treasury bills, corporate bonds, government securities, and other money market instruments. When you invest in fixed income securities, you become a lender to the government or the company issuing the bonds. As your investment is the loan, the bond issuer must pay back your money. Moreover, the bond issuer agrees to pay you a fixed interest rate called a coupon rate for extending this loan. As the interest rate is pre-decided when the bond is issued, these securities are called fixed income securities. Debt funds help you earn income through interest payments, and some of them also generate capital appreciation. For example, when you invest in debt funds, you earn interest payments and capital gains from a change in investment price.
Overnight funds invest in securities with a maturity of 1 day, typically money market instruments. Liquid funds invest in securities with a residual maturity of less than 91 days. Short duration funds invest in debt securities and money market instruments where the Macaulay duration of the portfolio is between 1 to 3 years. Macaulay duration is the length of time taken by the investor to recover the money invested in the bond through interest and principal repayments. Medium duration funds invest in debt securities where the Macaulay duration of the portfolio is between 3 to 4 years. Long duration funds invest in debt securities where the Macaulay duration of the portfolio is more than 7 years.
You may believe in investing in debt funds is risk-free. However, debt funds are vulnerable to credit risk and interest rate risk. The issuer of the fixed income instrument may default on the principal and interest payments of the instrument called the credit risk. Defaults on principal and interest payments on a security impact the portfolio of the debt fund. Bonds are assigned a credit rating by agencies such as CRISIL, CARE and ICRA based on the financial strength of the issuer. For instance, if the credit rating of an instrument gets downgraded by the rating agency, the price of the instrument falls and vice versa. Debt funds are vulnerable to the interest rate fluctuations in the economy called the interest rate risk, as prices of fixed income securities are inversely related to the interest rate changes. If the interest rate goes up, the price decreases and vice versa. Debt funds with a longer duration are more vulnerable to the interest rate risk than those of a shorter duration. You could explore fixed income investments that qualify for the income tax deductions if you want to diversify your portfolio beyond debt funds. You could invest in the Public Provident Fund or PPF if you are a conservative investor with a longer investment horizon. PPF is a tax-efficient investment as compared to debt funds. PPF qualifies for the EEE, that is exempt tax regime, where your investment up to Rs 1.5 lakh per annum enjoys a tax deduction under Section 80C. Moreover, the PPF interest and the amount you withdraw maturity are tax-free. However, short-term capital gains from debt funds on redemption within 3 years are taxed according to your income tax bracket. The long-term capital gains from debt funds on redemption after 3 years or more are taxed at 20% with the indexation benefit. Hence, PPF is more tax efficient than debt funds. However, PPF has a lock-in period of 15 years, making it unsuitable for short-term financial goals where debt funds are a better option.
PPF and NSC are government-backed small savings schemes and currently offer interest rates of 7.1% and 6.8% respectively. Your investment in NSC is eligible for a tax deduction under Section 80C up to Rs 1.5 lakh per annum. As the interest earned on the NSC is automatically reinvented, it can be claimed as a deduction under Section 80C. It is compulsory for all salaried employees with a basic salary and dearness allowance of less than Rs 15,000 per month to mandatorily register for Employee Provident Fund or EPF. However, you can also voluntarily contribute towards your EPF through the Voluntary Provident Fund Scheme or VPF. VPF earns the same interest rate as the Employee Provident Fund, which currently offers 8.1% for the financial year 2021-22. VPF qualifies for the EEE, that is exempt tax regime, similarly as the Employee Provident Fund and the Public Provident Fund.
I hope by now you have understood other investment options for debt fund investors. Comment clear if you are clear or drop your questions if any. Don't you want to know if debt fund investors should look at equity investments as well? If you are a conservative investor, you may prefer avoiding equity investments. However, studies have shown that equity investments may offer inflation-beating returns over time. You could consider hybrid funds which invest in more than one asset class such as equity, debt and gold. Many risk-averse investors look at conservative hybrid funds which are a type of hybrid fund. Conservative hybrid funds invest between 10% to 25% in equity and equity-related investments and the remaining 75% to 90% in debt instruments. These funds aim to generate income from the debt component of the portfolio and use the small equity component to provide a kicker to the overall return. You may consider conservative hybrid funds if you are willing to take a little extra risk with your investments.
Conservative hybrid funds may deliver higher returns than pure debt funds or bank FDs because of the inclusion of an equity component. However, they are riskier than the pure debt mutual funds as they have exposure to equities. Conservative hybrid funds are less risky than the equity-heavy hybrid funds as the concentration of debt instruments mitigates risks posed by the equity component. Moreover, these funds have a well-diversified portfolio where the debt component provides stable returns and the equity component enhances overall returns.
You may consider fixed income investments which offer tax deductions if you want to diversify beyond debt funds. It is suitable if you fall in the higher income tax brackets. However, many of these investments have a longer lock-in period and are suitable for long-term financial goals only. Thank you so much for watching this video. If you have any queries related to investments and taxes, please do comment them below as we will address them as soon as possible. Stay tuned for more updates and please don't forget to subscribe to our channel for finance related content. Take care and goodbye.